Welcome to an eye-opening journey where we unravel the truth behind the adage, a penny saved is a penny earned. When we were young, many of us were taught the importance of saving. It was ingrained in us that if we squirrel away our pennies, they'll eventually add up to a small fortune. It's a comforting notion, isn't it? Watching your wealth grow as you add to your savings day by day. But what if we told you that this seemingly prudent habit could be doing more harm than good? Let's dive a little deeper. The traditional concept of saving revolves around the belief that your money is safe in a savings account, slowly but surely growing with each passing day. It's a concept that's been handed down through generations, a tried and tested roadmap to financial stability. Yet, there's a specter that haunts the world of savings, a silent force that erodes the value of your hard-earned money over time. This specter is known as inflation. In layman's terms, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, our purchasing power is falling. To put it in perspective, imagine you've stashed away $100 in your savings account today. A year from now, due to inflation, the same $100 won't buy you as much as it could today. That's because while the number on your bank statement stays the same, the value of that money diminishes. It's a subtle process, almost imperceptible in the short term, but over the years the cumulative effect of inflation can significantly devalue your savings. It's like a stealthy thief, silently nibbling away at your wealth while you sleep, blissfully unaware. So if you thought your money is safe and growing in your savings account, think again. As we peel back the layers of the financial onion in the upcoming scenes, we'll explore how you can protect your money from this invisible enemy. Stay tuned for the next scene, the inflation effect. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Now, let's dive deeper into the inflation effect and how it eats away at your savings. Inflation, a term you've probably heard, but what does it mean exactly? Well, in the simplest terms, inflation is the rate at which the general level of prices for goods and services is rising and subsequently, our purchasing power is falling. It's like a slow and steady thief sneaking into your savings account and nibbling away at your hard-earned money. To give you a clearer picture, let's say you've stashed away $1,000 in your bank account. You're feeling pretty good about it, right? Fast forward a year later, and due to inflation, the cost of goods and services has gone up by 2%. Now, to buy the same things you could have bought a year ago, you'd need $1,020. But wait, you only have $1,000 in your account. That's $20 less than what you need. In other words, your money has lost its value. It's not that you have less money, it's that your money buys less. This is the inflation effect in action. You might think, well, 2% doesn't seem like much. But remember, inflation is a persistent force. Year after year, it chips away at the value of your money. Over 10 years, a 2% inflation rate would mean that your $1,000 would be worth about $180 less. And that's just the average inflation rate. Sometimes it can be much higher. During periods of high inflation, the value of your savings can erode even more quickly. So, what's happening to your money? It's not growing, it's not working for you. It's just sitting there, slowly losing its value. And that's why simply saving your money without investing it or finding ways to grow it, can actually end up costing you in the long run. Thus, even as your money sits safely in your bank, its value is continuously diminishing. But don't despair. There is a way to not just preserve, but also grow your wealth. Investing is the knight in shining armor ready to combat the dragon of inflation. But what exactly is investing? Simply put, it's the act of allocating resources, usually money, with the expectation of generating an income or profit. Imagine this. You have a seed, which is your hard-earned money. Now, you could either store that seed in a box where it will remain just a seed, or you could plant it in the fertile soil of investment. If you nurture it with care and patience, that seed can grow into a tree, bearing much more than it initially was. There are various avenues you can take when it comes to investing. You have stocks, bonds, real estate, and many more. Each of these can provide returns that outpace inflation, essentially growing your wealth in real terms. Let's take stocks, for instance. When you buy a share of a company, you become a part owner of that business. As the business grows and prospers, so does the value of your share. Over time, the return on stocks has historically outpaced inflation, making it a viable option for wealth creation. Bonds, on the other hand, are like loans you give to a company or government. In return, they agree to pay you interest over a certain period and return the principal amount at the end of that period. The interest earned can often exceed the rate of inflation. Then there's real estate. Buying property and renting it out can provide a steady stream of income, while the property itself appreciates in value over time. This dual benefit makes real estate a popular choice for many investors. It's important to remember, though, that each investment avenue comes with its own set of risks and rewards. It's crucial to research and understand these before diving in. So, the key to growing your wealth is not just saving, but smart investing. Because at the end of the day, you want your money to work just as hard for you as you worked for it. Yes, investing comes with its share of risks, but it also offers substantial rewards. Let's talk about that. When you invest, you're essentially taking a leap of faith. You're placing your hard-earned money into a venture, a company, a commodity, or a market with the hope but not the guarantee that it will grow, and in this leap, there lies the potential for loss. Your investment might not perform as expected. Market volatility could lead to a decrease in value. There's even the possibility that you could lose your initial investment entirely. These are the risks that come with the territory of investing. But here's the thing about risk. It's not inherently bad. In fact, risk is a necessary component of progress and growth. Without it, there would be no reward. The key is managing that risk effectively. This is where diversification comes into play. By spreading your investments across a variety of assets, you can mitigate the impact of any single investment performing poorly. Think of it as not putting all your eggs in one basket. Risk management also involves understanding your own risk tolerance. Are you comfortable with high-risk, high-reward investments, or do you prefer a more conservative approach? Knowing this about yourself can help guide your investment strategy. Now let's circle back to the reward side of the equation. When you invest, you're not just hoping for the best. You're actively engaging in a strategy that has the potential to significantly increase your wealth over time. The power of compound interest, the potential for capital gains, and the opportunity to earn dividends are just a few of the ways investing can provide substantial returns. In the long run, investing has historically outperformed traditional savings in terms of growth. So, while there are risks involved, the potential rewards can be well worth it. It's about being smart, being informed, and being strategic with your money. So, while investing does involve risks, it also holds the promise of greater returns. It's time to rethink your financial strategies and prepare for a future of growth, not decline. As we navigate the complex world of personal finance, it's crucial to continually educate ourselves. We've learned that simply saving money, a strategy once deemed foolproof, may not be the best approach in today's economic landscape. The key to financial security lies in understanding the power of investment. In this digital age, a wealth of resources are at your fingertips. Books and online courses, financial blogs, podcasts, YouTube channels, and even social media platforms offer a plethora of information on personal finance and investment strategies. They can help you understand the intricacies of stock markets, mutual funds, real estate investments, and more. Remember, there's no one-size-fits-all strategy. Each one of us has different financial goals, risk tolerance, and timelines. Therefore, it's essential to tailor our investment strategies accordingly. Consider seeking expert advice. Financial advisors can provide personalized guidance based on your unique circumstances. They can help you diversify your investment portfolio, balance risk and reward, and optimize your returns over time. While investing may seem intimidating at first, remember that every expert was once a beginner. Starting small and gradually increasing your investments as you gain confidence can be an effective strategy. And remember, time is your greatest ally. The earlier you start investing, the more time your money has to grow. The magic of compounding can turn even small investments into substantial sums over time. It's also important to keep up with the changing economic trends. The world of finance is dynamic. What worked yesterday may not work today. Stay informed, stay adaptable, and most importantly, stay invested. This journey towards financial growth may not be easy, but it's worth every step. After all, it's not just about securing your financial future. It's about creating a legacy that can benefit generations to come. Remember, the choice between saving and investing could be the difference between watching your money shrink or grow.